think, act, and prosper. You are now tuned into the Money Level Show.
Hello everyone, welcome back to the Money Level Show. Today we're going to talk about how to calculate your mortgage interest. All right, so this is how mortgages work. So you usually apply for a loan to the bank gives you money, you give this money to a homeowner, and you purchase this house and you use a real estate agent. Obviously, sometimes people, you don't use a real estate agent, but if you need a real estate agent, be sure to hit your boy up first, you know what I'm saying? But you use a real estate agent and you purchase a home. So this is money from the bank. So let's say this home cost about $300,000 and the bank is giving you a 3% interest rate. Which is pretty low right now. Right now they are doing about 2%, 3%. So that's pretty low interest rates. And then you are getting a fully amortized loan. So amortized loans are loans that they pile all the interest on top because you are entering a contract. So normally people enter mortgages with 30-year loans or 15-year loans, sometimes 20-year loans. If you're entering into a 30-year loan, that is usually an amortized loan where they pile all the interest on top of the loan and they have you pay most of the interest first before you start really knocking down your principal payment on the home. Remember, you got 30 years to do this. This is how it works. So to calculate your interest rate, what you do is you take your principal balance, which is how much is left owed on the home. So if you paid it down to $295,000, that would be $295,000 times the interest rate. If it's at $300,000, as in this case, that is $300,000 times the interest rate. When you do the math, so let's say $300,000 times 0.03, that's 3%, that equals $9,000. So this $9,000 is actually gonna be divided over 12 months because this is only for the year. So you would have to multiply this $9,000 by 30 years to get how much you were paying the bank. So as you can see, you're almost paying the bank a whole nother mortgage, $270,000, and your loan is for $300,000. So you're paying this much when you take out a 30-year loan at a 3%. That's how much you're paying over the life of the loan. You're pretty much buying the bank a whole nother house for them loaning you the money. Normally, whenever you're paying off amortized loans, you don't really start knocking down more principal than interest until about, I believe it's your 17th year. So I have a little chart right here. This is usually how it works. The red line is the interest rate. The blue line is the principal balance. So these usually intersect around year 17, where you're starting to pay more on the principal than on interest. So you're actually beginning to pay the loan off around year 17. So that is why it's always encouraged to pay more than what your payment is monthly. So you can see 1 year, 5 year, 10 years, 17 years, 30 years. Usually around somewhere in this point, they hit you up for a refinance. And whenever you refinance, you go back to the same cycle to where they pile all the interest on top and you're paying mostly interest, and then you're paying less principal until you get further down the line in the loan. So that is how that works. So 30 years, $270,000, that's how much you're paying on the life of the loan. Whenever you're doing your principal balance times interest rate, you divide that by 12 months. So for example, $300,000 times 0.03, that's 3%. You're paying $9,000 a year on this loan. So you're gonna divide $9,000 by 12, which is 12 months, and it's gonna total out to be about $750 a month, only in interest. So this doesn't include your principal, your escrow, your taxes, your insurance, and things like that. So that is pretty much how it works. So, and what you wanna do with the principal balance is you wanna use the new principal balance every time you calculate your interest rate. So whenever you pay a payment, say, $250 goes to your principal. Well, next time you're gonna use $299,750 and times the interest rate, then divided by 12. So you're gonna be able to see like the numbers change as you continuously do this process. So I hope that was helpful. That is how you calculate your interest rate on your mortgage. This also applies to credit cards and things like that. The difference is with credit cards, it's not amortized loans. Credit cards are based off a daily balance as opposed to a fixed balance of 300,000 for 30 years. That's how they pile all the interest on top, because they know that the loan is for this amount of time, so we can pile and get our interest first. So credit cards are only based on your daily balance. So, but it's similar. So I hope that was helpful. I want to thank you all for joining the Money Level Show today. Peace.